Good morning. Morning, everybody. A very warm welcome to Financial Fitness Fridays. This is episode number 24. Can you believe it? Been going for 2 or 3 years now. Obviously, this is the first one for 2023. This is the Cost of Living Crisis Special Edition, because a few things have moved on a wee bit since the last time we did a Cost of Living Crisis one, so that's no problem. I'm assuming that as nobody is complaining, you can hear me okay, so that's good news. If somebody wanted to just give me a thumbs up, that would actually make me feel good. Thank you very much. Okay, so what we're going to do today, my name's Darren Laverty from Second Sight. I'm a financial wellbeing strategist. I've been in this industry now since 1989, so 3 decades of experience. But I'm not the one whose brain you're going to be learning from today. We have a fantastic guest, a very popular advisor from Foster de Novo called Daffy Davis. So before we introduce him and bring him on board, he's a very popular advisor. Just want to talk about the cost of living crisis just a little bit, but also a few rules. Now, number one is we will end exactly on the half an hour. Okay, so it's a hard stop at half an hour. We won't turn off then though. If you want to stick around, we're then going to do Q&A. So I've got some preset questions for David. What we'd like you guys to do is, as we go through, use the Q&A function and put your questions in there. Then if you want to stick around after the half an hour mark, what we'll do is we'll pull out the questions which are relevant for, for a lot of people, and then we'll put those to David and we'll see if we can catch him out, because the other ones, he knows the questions that are coming. The Q&A afterwards, he won't. So let's see how we get on putting him on the spot. So regarding the cost of living crisis, what's quite interesting is I saw a survey. It's called the WorkHumans UK Human Workplace Index survey of 1,000 full-time employees across the UK. And what was quite shocking, it said that 84% of those people, so literally 840 of the 1,000, said they were feeling stressed and anxious due to the cost of living crisis. So it really is kicking in now. It's really here, really is here now. However, a lot of it's driven by the media, for sure. And I think the media have given us a lot of bad news, but they haven't kind of given us any subsequent news. And I know this firsthand because I work with organizations, and what we're doing, we are measuring the level of financial well-being inside an organization. And we have an assessment tool for that. And yes, for sure, the levels of stress have gone up a little bit. But the questions reveal something quite unique. And what we found was that whilst people are definitely more stressed about their money, actually, there's a question on there, and it asks them how do they feel about their financial condition, which means their creditworthiness. And interestingly, that is still strong. So what that tells us very clearly is that a lot of people out there are worried about their finances, but they're not actually missing payments yet or going over their overdraft limit yet. So they're actually visualizing problems to come and getting worried about it and feeling a bit out of control. And a lot of that can be fixed. So, we're catching it early. A lot of that can be fixed just with good information, relevant information, education, and actually making a few adjustments now before those things go wrong. So that's what today is really going to be about. So if you wanted to do that financial wellbeing assessment yourself, you can access it on our website. I've got a secret web page. It's second-sight.com/Darren, and on there you can go to the financial wellbeing assessment and try it for yourself. You get a little report, but the key thing is, what's your score? The average score at the moment is 6.1. It was 6.3. So if you fall below 6.1, you are slightly more stressed than average. Okay, just a kind of an interesting benchmark you might want to try out. If you want to see the other videos that we've got on the Financial Fitness Fridays YouTube channel, then if you search Financial Fitness Fridays, then you can find 23 other videos there. I've got a marketing team. What they might do is actually put into the chat function the links. I think they might be doing that now. Yes. Okay. So there's my webpage. You can check out the financial wellbeing assessment for yourself, and then there's the link for the YouTube channel. Right, okay, so without any further ado, let's get Daffy here. Daffy, are you there?
I am indeed. Good morning.
Ah, welcome. Thank you very much. I know you just come on the back of another presentation this morning. How did it go? Okay?
Yeah, very well. Very well. Thank you.
Good for you. So look, we've got some questions for you. you've had a chance to think about them. We'll try and catch you out later with some new questions from the audience. But I just want to start off with then, Daff, if it's okay. Look, the media, now they've scared the living daylights out of everybody in the last 3 years, and especially in the last 6 months, due to the cost of living crisis, for sure. From your professional perspective, you're dealing with people on a daily basis. Could you give us an overview of, very high level overview of a few things? What, in terms of inflation, where you think that's going, the investment markets, energy prices, and fuel.
Okay, and we've got this 30-minute hard finish. So that's probably going to be the most testing of all things for us to cover everything that we need to, along with some of the other questions. Interest rates have been going up significantly. Post-credit crunch, very low interest rates. We're down at 0.5% for a very long time. 0.5% per annum is what the Bank of England base rate was for quite a long time. Before the credit crunch, it was around 5% for a decade or so. Okay, so credit crunch, very low interest rates for a very long period of time. So a lot of people haven't actually seen more normal interest rates at all. So yep, interest rates have gone up, and they've gone up quickly, and that's going to be a problem for a lot of people, especially those on fixed rate deals. Oh, there we go. Fantastic slide. Look at that. There we go. Testing my memory here. Wonderful. So yeah, you can see before the credit crunch, it was kind of bouncing around that sort of 5% level, go back into the 70s and 80s, and it's all over the place. Okay, this kind of central bank's got more understanding of how to influence the economy a bit better, right? But that bit most recently, that kind of decade and a half almost, very low interest rates, almost free money was available in the world. And that's led a lot of people adopt quite unhealthy financial habits, really. Okay, now we are seeing that tightening of interest rates, tightening monetary policy, interest rates going up quite a bit. And that's mainly to control inflation, which has been a lot higher than anybody would like it to be in recent times. However, we are starting to see some murmurings of good news out there. There is a bit of light at the end of the tunnel, potentially. That inflation cap might be getting back in the bag. If you look at November's reading, it was up just over 10%. December's was down at 9.6% inflation. That's how much the cost of a basket of stuff went up over a year, effectively. So still a huge price increase, but it's slowing down a little bit. And in the latest letter to the Chancellor of the Exchequer, the Governor of the Bank of England wrote in December, it looked a little bit more positive on the inflation outlook. And whilst we've still got a little bit worse to come on these interest rates, probably, general consensus market rates are kind of 4.5% in the middle of summer. Then we are kind of anticipating them to come back down a bit, and by the end of 2024, maybe being back down towards 3%. So 3.5% currently, going to go up a bit more. That's going to be quite a pain point for a lot of people, and then coming back down. One of the things that's a really big problem is kind of the mortgage ticking time bomb that's sitting there in the background. Everybody who got a fixed rate last couple of years, whether it was a 2-year or a 5-year, a few more years back, no doubt got themselves an absolute steal of a deal. Okay. And when that deal comes to an end, they're going to get a bit of a rude awakening to what the current interest rates are and what that means for their payments. So interest rate outlook, it's not looking quite as bad as it was. We're starting to see some light at the end of the tunnel there, with kind of potentially when it's going to be coming back down again. Inflation starting to slow a bit. It still means things will increase in price. It's just the rate of increase will be that bit slower. When we look at investments, last year, torrid year for investments, all the geopolitical risks and concerns around the world, which really are not good. It was 31st of December 2021 when markets hit their all-time high, when the States S&P 500, biggest market in the world, hit their all-time high. And then as the Federal Reserve in America, their central bank, their version of our Bank of England, started introducing interest rates, that started seeing their financial markets sell off quite a bit. They actually entered a bear market last year. So investments over the last year, it's not been a lot that's been doing very well. Let's put it that way. But that does present a bit of an opportunity for people. If you've got a bit of time on your side, do you want to be putting money into investments when markets are fully priced? Or would you rather go shopping whilst things are on sale? And one can think that the sales have definitely started. Lowest price reductions might have been seen already. Lower times could be ahead of us. But when markets do trend down like this, it does kind of give a quite a sensible opportunity to start trying to put a bit more money in if we've got the capacity to be able to do it, quite frankly. So inflation slowing down a little bit, not quite out the woods yet. Interest rates probably going to go up a little bit more and then come back down. But a lot of people have been shielded from that with their fixed rates. So it's starting to, for anyone who's got a fixed rate mortgage, get a flavour for what the current rates are, try and get some clarity what that will mean for your payments on the mortgage. And then on investments, pretty much anything that you look at over the last 12 months, it's not going to look good in that individual period. But remember, with investments, it's about time in the market. That makes the biggest difference to it all. And markets go down as well as up. And when you zoom out on any kind of chart, you'll see there's these bits. It goes up really nicely, comes down, it goes up again. And that's what we look to benefit from over the longer term. So
look at, it's just going to help if I do this. That's a year.
And okay, so this is the Bulk Pension Fund within the Scottish Widows Pension. So if you're in the balanced pension investment approach, targeting flexible access, you haven't gone in and changed anything. If you're more than 15 years away from your target retirement age, this is what your money will be in, okay? And we can see there at the low point, this sold off about 16%, okay? Part of that was global equities selling off. Also, we had Liz and Kwasi's rather interesting period of leadership, put it politely, which caused a bit of turmoil in financial markets. But you can see what I'm saying here about us maybe having seen the lowest of the lows be behind us. No one's got a crystal ball. This is all just kind of looking on where things are currently.
You look at slightly further out, there's 5 year.
Yeah, that's a beautiful one to look at. Yeah, so having a look there, you can see quite nicely the COVID sell-off beginning of 2020, and then that rebound, that's about a year. Start to finish about a year and a half for it to get its head back above water, effectively. Really nice push on. And then we've got this choppy period. And you can see that quite nice rebound. That latest rebound, that little kick that you're seeing, that's all being driven by this kind of more positive inflation news. And the market's starting to go, okay, hold on a minute, interest rates might not need to go as high. Now that's got nowhere near as much coverage as all of the negative stuff we've had last year, quite frankly, because good news doesn't sell papers or doesn't generate clicks, I suppose, is kind of the more modern way of phrasing it.
Okay, that's brilliant. Thank you very much for that. So just on I think the thing that seems to be worrying people the most is those on fixed rates that are going to end this year. You know, are they expecting to be looking to be paying double what they're currently paying, or just a rough guide?
Well, I hate to be the bearer of bad news, but if you've had a fixed rate for the last few years, that might be at 1%. There were fixed rate deals available at even below 1% a few years ago. Now, if you're looking at a fixed deal currently, they are starting to come down a little bit with how the pricing works. But if the base rate creeps up again, then you're going to see another step up or so. So rates of 4.5% probably available now. So if you were on 1%, that's going to be almost a quadrupling of your interest rate. Okay. Bear in mind that doesn't mean a quadrupling of your mortgage payments, because your mortgage payment is made up of the interest that's due on the debt and a chunk that's going off the capital each month. So depending on your mortgage term, it's going to have a variable impact on the actual payments.
So probably be wise to start to adjust now, get used to putting extra money aside and living within your means in advance, get used to it and see where you can cut costs and manage things differently.
Very much so. I'd say that the starting point is getting real with what it's going to look like, okay? And trying to get yourself in that better informed position of if your rate's ending in a few months, 6 months, 9 months, don't just wait until that happens to then feel the pain. Get the information now, get the information sooner rather than later. So you've got a bit more time to make an adjustment to how you're spending your money, okay? And I'm not here being a complete miser saying don't spend anything on anything at all, okay? But review everything you are spending your money on. Are you getting sufficient value from it? The car insurance, the mobile phone contracts, the weekly shop. Look for every aspect. One thing I always say to clients I'm working with is say, initially, have a think about where you spend your money. Get a pen and paper and write down what's coming into the bank account and what you spend money on typically, just from memory, right? Then go back through your last 3 months expenditure and get in touch with where you have spent your money, okay? And that can be a really enlightening exercise because those little coffees and a sandwich on the go, they all add up. Okay. And if it's something where you're looking at that and you're going, that's a little bit enlightening, a little bit surprising, then great, make some kind of change to your expenditure pattern. If you always do what you've always done, you're always going to get what you've always got. Okay. So you need to have a change there. And it's first of all, looking at where you have been spending, and then have a think about where it is you'd like to be spending and where you can potentially squeeze those cost bases. You know, you only get the opportunity to spend each pound you earn once.
Tell you what I'm going to do. I'm going to stop you there because I think we're going to get some practical ideas towards the end. I don't want to dive too much. If anybody wants to know a bit more deeper dive into the mortgage market, the previous Financial Fitness Friday we did is a special mortgage edition. If you go to the YouTube channel, you can find it on there. It's the last one we did, number 23. So take a look at that. Some really good advice from a mortgage specialist on there. Okay, another question here for you, Henry. Called him Henry. David, sorry, the other guy was called Henry. Now, I read some research recently, and it said that as many as 20% of employees have stopped or ceased or reduced their pension contributions so that they can increase their take-home pay. Now, I was talking to someone the other day, and it's a lot of this is in the civil service where they've got like 10, 11, 12, 13% employee contributions, and there's no other option for them. So could you share with us your thoughts here, David, on the negative effects and what it might look like for people considering doing that to try and free up some cash?
Is it an option that's on the table? Yes, it is an option that is there. I'd view it almost as a sort of a final thing to be considering once one's looked at all other aspects. Okay. A really good thing to look at as well is the actual difference it will make to your take-home pay. So whilst that percentage can sound quite large, if somebody's on £30,000 a year, 10%, it's £3,000. So that can sound like quite a big chunk of money. But the net impact on their take-home pay isn't going to be as big as £3,000, right? So the key things when you're looking at this to really understand what difference that would make: basic rate taxpayer, 20% income tax, 12% national insurance. Okay, so each £100 is going to give them £68 extra.
So that 3,000 is effectively closer to 2,000 net take
exactly.
home.
And for a higher rate taxpayer, it's going to be even less of an impact. Okay, now this is looking at kind of the near term kind of improvement on the cash flow basis. All right, and it's that even just doing it for a few years can have quite a significant impact on the overall benefits we get when we're retired. Okay, so it's really using that as a last resort. If everything else has been looked at, there's on the mortgage session, there's a bunch of options that are talked through on that one about how you can kind of tinker with the mortgage to weather the storm a little bit. Okay, there's a lot of options that can be done there. But in effect, even just being out of a pension scheme for a year or two, you're missing out on all the employer aspects as well with what your employer's doing on that side of things. The improvement on your take-home pay may not be as impactful as what you think it would be. And I mentioned this phrase earlier where in that period, the last 15 years or so of really weirdly low interest rates, people adopted some unhealthy financial habits. There's quite a big risk that if you opt out of a pension and don't really address the spending and the other financial stresses, that what you think might be a 6 month, a 9 month, a year thing ends up rolling into 2, 5, 10, 20 years. Next thing you know, you're retired and you've got a fraction of the pension benefits that you were looking forward to. So is it something that can be done? Yes, it is. If you're considering it, I'd suggest looking at everything else before and optimize every aspect of your finances first to see if that can weather you through the storm. I mean, it can be a little bit harder, but things are going to get better at some point. Don't know when exactly.
I think
very much use it as a last resort type thing.
I think I've been through. I mean, I'm so old now. I've been doing this for a long time. I think I've seen this is my third kind of recession, and I think some good does come out of it because we've had it very good for a long time. We've had a decade of very low interest rates and kind of got used to it and took it for granted. Now things are normalizing somewhat, and we're having to cut our cloth. We're having to change our habits and behaviors But can you imagine if we start to, this is an opportunity to change those and make them something that's going to change us for the long term. Because when things come good again, we've got those new fantastic behaviors in terms of, cutting our cloth, taking control of our money, saving and investing. And that should serve a lot of people over the long time. So sometimes you're going through a difficult time, we come out stronger. If it hasn't killed us, we come out stronger. So for a lot of people, I think this, when we look back 10 years from now, that was a moment where things changed for me. And actually it's done me a favor in the long term. I know it's hard to feel it right now, but that's possibly very true. And I've seen it several times with clients over the years. So another question for you then, David. Now, in the last session that you did, it was the one that you did, there was a lot of talk about this concept of pound cost averaging. And there was a lot of clarification questions asked. So I thought, let's just bring it back up again and just spend 2 or 3 minutes explaining, bearing in mind, the investment markets have been volatile. We've seen that. They're going up and down all over the place. So why can this be a good thing for a regular investor?
So the concept of pound cost averaging is where you're putting in the same amount each month, irrespective of what happens in the world. Okay. So when markets go down a little bit, and effectively you're buying things when they're on sale, which means for the same amount of money, you can buy more investments. So you end up with a larger investment, larger number of investments, more units in the investments, which then means when the good times come, you benefit far more on the upside. If you sort of saw 2 charts of investments, and one was a nice tidy return, and it just went in a straight line and made some jolly good returns, and one went down massively and then went back up a bit, a lot of people, especially the more novice investor, would quite like the straight line. Okay, nice steady return, constantly watching it go up. But actually, when you're with the way that we work with investments, generally we're putting money in every month and buying some stuff all over the place. Okay, so when things do go down, for the same amount of money out of your pocket, you're buying more investments, which means when the good times come, you benefit that bit more on the upside. So it's kind of trying to capitalize on market volatility in a way. And in effect, the best thing that could happen to us is we start, talking about pensions, you start working, markets go right down, you buy loads of stuff when it's really low, and just before you retire, they absolutely rally. That's never going to happen, okay? But throughout our life, our working lives, as you mentioned, you've seen several recessions, big sell-off in markets. Every time they happen, it means that people who are able to continue their investments, they're able to go shopping whilst things are on sale, buy a load of really good investments at much lower prices, and it just helps sort of turbocharged on the upside as the markets recover, really.
So would you say then that for those people that aren't too affected at the moment by the cost of living crisis, that if they can afford to put a bit more into their medium term and their longer term investments on a monthly basis and take advantage of pound cost averaging, not a bad time to do it?
Very much so. And even for those who maybe are a bit more comfortable currently, still doing that whole thing about the financial assessments and looking at where you can make sure that you're trying to reduce your cost base, increase your surplus cash flow, and really capitalize on the sell-off that we've seen. Key things you've got: pensions. You can get some wonderful tax relief, get that gross amount going across. Okay. Bear in mind, currently you can access your pension from age 55. So if you're getting towards there, it's not locked up for as long as somebody who's 25 years old. And that's changing in 2028 to 57, by the way. But indeed, trying to direct a bit more across to those things when markets have sold off a bit is something that future you will only be thankful for, by the way.
Okay, brilliant. I'm conscious of time, so we've got a few minutes left yet. So what is always very popular is practical ideas. So I challenge, I don't know what you're going to say here. I don't know what the answers are, so I'm hoping they're going to be good. So could you share with us your 3 favorite practical ideas that people could take advantage of right now?
First and foremost, when you start to look at your finances, it's all about having that budget, having that transparency, and being in control of your money, knowing where you spend, what you spend, and making sure you're getting sufficient value from it. Okay. So irrespective of where you are in your financial life journey, it's all about, the first point I would say is look at your money, look at what's coming in, what's going out, and make sure that you're getting good value from everything that you're spending your money on. Try and create that surplus and try and get it a bit bigger and to be able to balance books out a bit better, because the more surplus you've got, the more opportunity you've then got to be able to save, maybe pay off those credit cards if you've got some interest rates creeping up. And then once you've kind of got yourself in that bit better financial position, you're then able to start looking at more investing type stuff. So I mentioned about budgeting a few times on the call. Really, that is an important thing. It's something, all the biggest companies in the world, they know exactly what they're spending, when they're spending, and they're getting good terms on what they're spending their money on. So just go and copy that. Be a bit more transparent with where your money's going effectively. That would be sort of the first point. I'd say, of course, it's fine. I've got to turn for time. That's going to take too long to stay here. Okay. If you've got some savings, so this might be one I can run through. If you've got a chunk of cash sitting there, okay. At the moment, the best you're going to get on it's 3 or 4% probably, right? Which is a lot better than we've had for many, many years. So it's going to probably make you feel quite good that you've got some cash savings. Now you're going to be getting some interest on that for once, right? However, inflation is knocking on 10%. So with cash, you're kind of guaranteed to be losing money in real terms after inflation. The number never goes down, but what it will buy you in the future will be decreasing with the interest rate being that bit lower than inflation. So we need to hold the correct level of cash to be financially resilient and handle those curveballs that life's throwing at us, as it were. But if you've got a bit of a sort of a heavy load of cash in your existing position, you need to be asking yourself why, what's its purpose, what's it for? And if it's money that maybe you're not going to be spending for a few years, then much like we were talking about with the investments, things have sold off a little bit. Maybe look at trying to put some of that money to work in investments so that you're able to actually get that money working hard for you like you have for it. So I'd say budgeting first and foremost. Let's try and get more transparency and more clarity over where your money goes. With your cash, have a look at it, hold the right level of cash, but don't hold too much. It's not only an anchor on that speedboat to wealth creation, it's like putting the thing in reverse, okay? Because inflation's eroding the buying power of it year in, year out. And then the third point, pensions are probably the most tax efficient wealth creation vehicle we've got available. If you've got some surplus cash flow currently, then indeed looking to be able to contribute a bit more of your salary across, buying a bit more whilst the sales are on effectively. It's something that's just going to boost that retirement.
Okay, brilliant. Thank you very much. I just need to do a screen share to get the caveats in there so that we keep the regulator happy. So I'm just going to put that up. Okay, so now we've finished the half an hour session. Thanks very much, Daffy, for your input. What I'm going to do, I'm going to go to Q&A now. So anybody that wants to stick around for 10, 15, 20 minutes, put your questions into the Q&A. I'll put them to Daffy, and let's see if we can put him on the spot, catch him out. So let's see what we've got so far. I've got one question here regarding budgeting. You mentioned budgeting. Is there a budgeting tool that you would recommend people could take advantage of? Preferably one where they're not trying to sell you something.
Yeah. Moneyhelper.org.uk. I know someone's able to pop that in the chat or something to be able to give people access to the link. First of all, do points 1 and 2 that I mentioned. Get a pen and paper, write down what's coming in, what you think you're spending currently. Then do that analysis of the last 3 months to get in touch with where you have been spending your money. And then it's going to put you in a far better position when you're doing your budget to make it real and make it one that you can stick to and that you're going to be getting positive reinforcement about because you're able to stick to it rather than just kind of going into it cold with, right, this is what I'd like to spend and missing it massively each month. Be realistic, make sort of small adjustments over a period of months to get yourself to where you want to get to. But yeah, moneyhelper.org.uk, and on there as well, there's a bunch of hints and tips about household bills and how to get better terms on things as well. So it's a good site to have a look around in.
Yeah, I think our team has pasted in the link in the Q&A, so you can grab that link and go to the Money Helper, which is good. I've actually tried it out myself, and it is really good. It's a very all I say to you, I just challenge you to try it for 10 minutes. Once you're in and doing it, you're away. It feels like a tedious thing, but we've got to do it. We've got to take control, because the more in control we feel about finances, the less stressed we are. We can't control everything, so we just need to make sure we are in control of the things that we can control. And money in and money out certainly is the thing. So we've got quite a few questions coming through here, Daffy, so I hope you're all ready for it. Question here, you mentioned correct level of cash. How do you figure out what that is for you?
Looking at your life costs, what it costs you to exist effectively, kind of the optimum level generally is about 3 months for most people. Okay, and having 3 months life costs. We're not talking just the essentials, the direct debits and household bills. We want to have, you know, a general life costs added in there as well. So the petrol for the car, food, all these other bits as well, right? The reason for that is generally the more that we spend regularly, the bigger our curveball bills can be as well. Okay. Someone could think a bit about, you know, if that's kind of quite a lofty target to get to today. First of all, just go for £1,000, a nice round number. Keep it simple. That's the first target, £1,000. Secondary target, that 3 months of life costs. If you've got more than 6 months of life costs in cash, however, kind of got to ask yourself why. Why do I have such a big rainy day fund? I mean, what kind of downpour am I waiting for? And if it is something that you go, okay, actually that's a bit too much, then of course that's when you want to start looking at putting that to work for you in investment, so forth. Just a little thing on the emergency fund as well. I don't know if many people on the call have tried to do a bit of saving. They get paid, they move the money on their online banking into their savings account. They feel good on payday because they're like, great, move that money across. And then as they get closer to the next payday, that money starts getting drip fed back in. Okay. An idea here is to have your savings account with a separate banking provider, different login details, out of sight, out of mind a little bit. You can still move the money. It's not a million miles away, but it just means when you're logging into your online banking, you're not seeing it there every time, and kind of it's a couple more clicks away is kind of the theory there. So that's a good way to try and think about things, to try and make it just a little bit easier to cut your cloth according to your means, rather than do that wonderful saving at the beginning of the month, and at the end of the month, you've undone it all.
Yeah, do your saving first. And there's an old saying back in the day, and it's like, pay yourself first, which is put some money aside for you, and then the rest of the money goes to other people that you live on. You know, pay yourself first. It's kind of a good concept. There's 2 questions here which are kind of similar. It's about investing. Now, you know, financial advisors are, you know, because of the regulation and the qualifications they require, they're sort of out of reach for a lot of people. And I remember back in my day, 30 years ago, you know, we could earn enough money to actually persuade people to start saving. But that's kind of history now. And we have to rely on things like this to encourage people to start saving. So once people have made that decision, they want to save and then they want to invest, you know, where can they go to do it? I mean, someone said, is there a beginner's guide? No idea where to start. Where do I go? You know, I use Vanguard. Is there any other well-known, recognized ones that have low fees? So there's a sort of general question. If you're starting out today, where would you go to get some kind of investment vehicle? What might that vehicle be?
Before getting the investment vehicle, bump up your knowledge first and foremost. Okay, so the financial education program that we provide for various other employers, great thing to be able to improve your knowledge base and just get that knowledge up a little bit. Okay. There's a bunch of robo-advisors out there, which kind of set and forget type things. They've got their risk mandates. You can pop some money into those types of things. I need to be kind of careful with what I say on that front. I must say there, Darren. So, but yes, and it's something as well that's for a lot of people, you know, financial advice is something that's an initial chat doesn't cost anything, and there's no obligation with that type of thing. And it might be something where somebody just needs a couple of pointers with where they are, and it is a case of, you know, a bit of robo advice will do you right for now. Let's chat in 3 or 5 years, you know. But that initial conversation is something that usually benefits quite a lot of people nonetheless. So they can always reach out to Second Sight and have a chat with one of the team to see if it's something where actually with their situation, it is something where we can help them at the level they're at, maybe. Who knows?
And people should probably start with an ISA because it grows tax-free.
Yeah, I mean, well, if we're talking wrapper basis, it all depends on when it is you want to be able to have access to the money. Okay. So ISAs, you can access it whenever you want. Okay. So if you're that bit further away from pension access age, then yes, ISAs, £20,000 allowance each year you can put in there. That can then be invested. All the growth is tax-free, and taking the money out is tax-free, and you've got no lockup on it. Okay. Pensions, on the other hand, your money's going in before you pay taxes. So you're getting a huge uplift. A higher rate taxpayer, £58 in your pocket, post income tax, national insurance, £100 in the pension. That's quite a big initial hit. Okay. So if the money that you're saving, that you're investing, you're happy to be able to have locked up until pension access age, then probably a pension's the first port of call, really. So pension isn't just for retirement, it's for money to access from age 55 onwards, currently 57 from 2028. If that's quite a while away for you still, then okay, indeed, yeah, ISAs to be able to get some investment, some of that money working hard for you, that's not locked up for multiple decades if maybe in your 20s and really starting out.
Yeah, so I think people are kind of desperate to get some names, right? So there are companies, there's companies that advertise on the telly. So if you want to start investing, if you Google, online ISAs, you're going to come up with companies like Hargreaves Lansdown who advertise on the telly. There's a company called Cushion. So there's various companies out there that actually provide online ISAs. So you don't have to do it through an advisor. Sometimes you can get one through your bank. But also, most of the mainstream group pension providers, they have ISAs available too. They don't always tell you about it, but they're available in many cases. So go back to your HR department, have a chat. Sometimes you'll find that the pension provider might be able to provide it for you. And what the good news about that is, often the very low charges that your employers negotiated on your pension can often be mirrored in the ISA. So that's definitely an option to consider. Find out if your group pension has that facility. If you go to your online portal for your group pension, you might find there's a tab to go through to invest in ISA there. So definitely worth having a look at that. So another question here then is, here we go. Here's a cheeky one. So we'll see what you say to this one, David. Crypto or premium bonds?
We can't give any advice today at all. And personally, for me, I would be putting my money in premium bonds. Okay. It's interesting if you look back, so a little bit on crypto, just because a lot of people have got it. Okay. And this is my personal opinion, not any form of advice, but the blockchain technology is kind of like the internet in the 90s. Okay. If you look at the dot-com bubble, what happened there, you had all these websites that were on the internet, and some of them went to crazy valuations and then disappeared from existence. Who would have thought that an online bookshop in the 90s would become the Amazon of, well, will grow to be what it is now, it's Amazon. It started out as an online bookshop, right? So anything that's highly speculative, where things can go up very quickly, can go down very quickly indeed. And I tend to prefer prudent, sensible investing rather than more speculative investment. You only get one opportunity to spend your money or to invest your money. And if I give you an example, if somebody does some high risk investments and they make loads and they lose it, and then they do some more investments and they make loads and they lose it, and they do some more investments, make loads and lose it, they end up at the end with nothing still. Okay. If instead they do some far more boring, non-sexy, non-shiny, simple, proper investments, okay, they can benefit from compound growth over the longer term. And that's where real wealth creation comes from. So anything, if people are going to have a flutter with anything that's got a risk of total loss, then it needs to be money that really isn't going to have any impact on their lifestyle. And if it went to zero, they'd be perfectly fine.
Okay, brilliant. There's a question here that we get all the time. I've got a chunk of cash. Should I invest it, or should I pay my mortgage off? Pay some of my mortgage off?
Very good question. And sometimes it doesn't have to be all or nothing. It could be a bit of both, quite frankly. there's a range of options there. The first thing that I'd say is, generally speaking, mortgage rates are a lot lower than inflation. Now, I've mentioned inflation a few times with cash and how it's a terrible thing. It erodes the buying power of your money that you're holding in your bank account, right? With debt, inflation's quite a wonderful thing because it's devaluing that debt in real terms. So as long as you've got a strategy for your mortgage to be repaid at some point that's manageable and fits with your life plan, then I generally tend to lean towards the idea of sticking to the plan with the mortgage and then looking at maybe some tax efficient investment strategies with the cash. And it could be a bit of both. You know what I mean? It doesn't have to be an all or nothing situation here. But if you bear in mind with your pension, you get all that wonderful tax relief on the way in. When you take the money out, 25% tax free. The rest of it, just whatever taxes are applicable when you do the withdrawals from it. Probably basic rate taxpayer for most people. So I generally say, as long as the mortgage on a repayment basis, kind of stick with it on the terms that you're on, and then consider looking at putting that money to work in sensible, well diversified investments, nothing speculative with the risk of total loss.
Okay, brilliant. The next one is final question, I think, and then we're going to have to end it because we're running out of time. By the way, I'll ask this question in a moment. Anyone that's still on here, thanks very much for sticking around. When you come off of the Zoom, you'll be taken straight to a feedback form. And please, if you could spend 1 minute just completing the feedback form for us. We want to make sure that we fine tune and hone this experience and make it better and better and better. So if you look to the first one we did going back 2 or 3 years ago, number one, compared to now, they're quite different. We've taken that based on your feedback. So we really, really do appreciate it. If you've got something nice to say, let us know. If you've got some constructive criticism, please share that with us. We'd love to. And if you've got any particular topics and subjects you really want to learn more about, let us know. And then we can put that into the melting pot. And when we can plan for the next one, we might be doing your subject. So thanks very much for that. So the final question is, there's a few of these actually. I think it's obviously young people thinking about getting on the property market now. We've got interest rates unsettled. We've got, property market. They're worried about, they're going to miss the boat with the real estate market. Do you have a view on the future of real estate in and around London area, for example? This particular person's asked, should they wait until interest rates settle? Should they do it now? Any opinion on that? Thoughts? No advice?
Yeah, okay. I'll throw my 2 cents into the ring here. Post the credit crunch, going back to that period, property prices recovered quite quickly, and loads of people said that they were going to come back down again. Okay, and they sat on the sidelines for a decade and missed out on property prices going through the roof. Okay, one needs to look at the opportunity cost. So if you're not owning a property, instead you're renting somewhere, if your rent's £12.50 a month, that's £15,000 a year that the cost is of you not being in property market. The sooner one can get on the property ladder, let's call that, because your first home's not your forever home, generally the better in my eyes. Even if you time it terribly, at least you're not paying the rent. Instead, you're paying off your mortgage little by little. And the property price appreciation over time. If you're going to buy a place and be selling it in 2 years' time, that's a bit silly. Okay, you've got all of the costs associated with buying the place, and in the short term, prices can fluctuate and it might be less, which is a problem. But if it's something where you're going to be there for quite a few years, then if prices do dip a little bit, it doesn't really matter. And what you're doing is paying off your mortgage rather than kind of wasting the money on rent per se. With regards to the interest rate bit, interest rates before the credit crunch were around 5-6%. Lenders were lending 5 times income. When interest rates have come down as much as they have, lenders haven't suddenly started increasing the amounts they'd lend because of all the additional affordability assessments that came in. Basically make sure that banks are far more prudent. Okay, so you can still borrow the same kind of money that you could in the previous interest rate world where we were at. So these aren't going to high interest rates. It's kind of more of a return to kind of more normal levels. If you think about supply and demand as well, when you're buying something, do you want to be buying into a hot market where loads of people are chasing each property, the transaction's going to be done there and then, you see it listed for X amount and loads of bids come in and it's going massively over what it was listed at, so you're missing out on all the places that you're looking for? or when it becomes a little bit of a softer market and it becomes a bit more of a buyer's market, it means you get a little bit more time to do more considered purchase. And prices might soften a smidge, which if you're going to own the place for 5, 10, 15 years, it's not going to make a huge difference on that side of things. So kind of the sitting on the sidelines aspect, it's got a lot of costs that come with it, a lot of risks. 3 years at £12.50 a month rent, that's £45,000 you've spent in rent. Who knows what property prices will be in 3 years? So I'd implore anybody who's thinking about getting on the property ladder, speak to a mortgage broker, get your numbers confirmed, utilize the lifetime ISA if it's relevant for you. Put £4 a year in, government gives you £1,000 for nothing. Okay. Look at the T's and C's of it though, make sure it's going to be viable for your level of purchase. Yet again, your mortgage broker will be able to brief you on that in more detail.
Brilliant. Well, we have run out of time officially. Thank you very much indeed, Dafydd. Everybody else that's on the session, thank you for joining us. I hope you got something out of it. Go to the YouTube channel and check out the other ones as well. And please, 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 if you'd be so kind, when you come out and we'll be taking straight to the feedback form, if you could give us some feedback, we'd really, really appreciate it. And I'll look forward to seeing some of you again on the next session. Not sure when it's going to be, but probably be about a month away. We'll keep you posted. Thanks ever so much. Thanks again, Dafydd. Take care, everybody. Bye-bye.
Thanks for having me. See ya.